Americans like you are leaving billions of dollars in tax savings on the table, and I'm here to help you figure that out. Today, we're gonna be going over the most overlooked tax deductions and credits so that you could put more money back in your pocket. I'm Matt Franchina, AKA the People's Advisor. For the last 16 years, I've been simplifying complex planning, helping you protect your health, build your wealth, and secure your legacy. Let's get into it. All right, first, let's start out. What's the difference between a tax deduction and a tax credit? They're both valuable, but significantly different. A tax deduction is going to be something that reduces the amount of income that is considered taxable. So for example, if you have a $5,000 deduction and you made $95,000 that year, only $90,000 would actually be eligible to go through the tax grid. So here's an example of a deduction, an IRA contribution. If you have a traditional IRA, and you deposit $5,000 into that, that amount of money is going to be reduced from the income you made last year. Now, you will pay taxes on that eventually, but that's when you draw it out of that IRA, hopefully in a lower tax bracket in the future. Now, we do have a video where I dive deeper into that. So if you haven't seen our series on these different tax benefits, make sure to go back to the channel, look at some of the other tax videos we've done. Now, a tax credit actually reduces dollar for dollar the amount you owe in taxes. So for example, that 95 grand, we reduced it to 90,000. It comes out still that you owe $3,000 in taxes. A tax credit would directly reduce that $3,000 you owe by whatever the credit is. For example, an electric vehicle tax credit. If you purchased an electric vehicle in 2024, you may be eligible for a tax credit up to $7,500 if it was a new vehicle and $4,000 being the cap if it was a used vehicle. Now, again, both of these are valuable, but tax credits tend to be the one that takes the cake because they dollar for dollar reduce the amount you owe versus just reducing the amount that runs through the tax grid. Just a reminder, I'm not a licensed tax professional, I'm a financial advisor. So I've got a list here of 8 commonly missed tax deductions. First on the list, student loan interest deduction. Now, if you have a student loan or you've got kids and you took a loan out for their college, good news is you get to write off some of that interest. The limit is $2,500 for 2024, so make sure you keep those statements and you use those as a deduction. So if you've got a health insurance that qualifies you to open a health savings account or HSA, make sure that you make those contributions. As a single individual, you can deduct $4,150 in health savings account deposits, or as a family, it's up to $8,300 now. And I just want to put out there, you have until April 15th of this year, or when you file your taxes, to make a contribution and make it count as last year. So if you need a deduction, you haven't done that yet, let's talk about getting an HSA open for you. Next up on the list, IRA contributions. Also eligible until you file your taxes or April 15th. If you're an individual under the age of 50, your limit is $7,000 in IRA contributions for last year. And if you're 50 or older, you get an extra $1,000. They call it a catch-up. It's just to stimulate you being able to put a little bit more money away towards retirement. Next on the list, penalty on early withdrawal of savings deductions. So if you had like a CD or banking product that had a penalty if you canceled it early and you happen to need to tap into that money and you took a little penalty, you get to write off some of that penalty. So make sure that you get those receipts from the bank, you use that, and you get back as much of that penalty as you paid as possible. Educator expense deduction. So this is specific to teachers, but if you're a teacher K through 12, you spent some money on supplies, odds are you spent more than you can write off, but you can claim up to $300 and deduct that. Self-employment tax deduction. If you're self-employed, then you know you pay some self-employment taxes. This is basically Social Security and Medicare, what your employer would have paid if you were W-2. But since you're self-employed, you're paying that tax yourself. It does count towards a deduction though on your income, so make sure you claim that. Self-employed health insurance deduction. Look, if you're self-employed and you have health insurance, you get to write that off 100% 1% for you, your spouse, and your dependents. It could be a massive deduction because health insurance, it's a pretty penny these days. So if you're paying for that on your own, you should definitely write it off. And you know, if you're self-employed and your spouse is not, might be something to consider this year. Is it worth buying the insurance through the self-employed person, allowing you to write all of it off, or taking the premium from the employer-sponsored account through your spouse? Something to just look at. Every situation's different, but don't overlook it. You can plan differently this year to hopefully put more money into your pocket next year. And one more would be for you active duty military. First off, I want to thank you for your service. If you're out there protecting our country and our freedoms, I am so grateful and do not take it for granted. But you have a tax credit here. So many of you in the military, you've got to relocate because it's a required duty of yours to move around or be relocated. If there's expenses involved in that, then you get to write some of that off in the form of a deduction. So active duty military, do not bypass that deduction. Make sure that you're getting as much as you can back from Uncle Sam, since, man, you're putting in a great service for us and you should keep some of that money. Now that we have gone over tax deductions, which reduce the amount of income that passes through the tax grid, I want to touch base on tax credits, right? These are direct dollar for dollar offsets of the taxes that you owe. First up on the list, this is for your low to moderate income earners. You have an opportunity to have a tax credit of up to $7,830. This is for the earned income tax credit. Next up, lifetime learning credit. So you have up to $2,000 for tuition or higher education expenses that you can write off. Now, there are lots of things outside of just traditional school that can qualify for higher education. So you're going to want to do anything that you use to improve your skills, take a look at and see if you can make that qualify. Energy efficient home credit. I know you've been getting hit up by those solar people. Well, some of the things they're saying may be true, like you can earn a tax credit. If you've improved the energy efficiency of your home, you have the opportunity to take $3,200 in credits towards things like HVAC, solar, stuff like that. I believe it's 30% of the expenses can be written off up to that cap of $3,200. Next up is the electric vehicle credit. Earlier, I gave you an example of that. Look, if you bought an electric vehicle last year, you get a $7,500 tax credit, and if it was a used vehicle, it's $4,000. Now, there are some income limits and things that apply. Other thing you want to look into is, depending on the state that you live in, some states will give additional credits towards state tax for that electric vehicle purchase. Child and dependent care credit. This is for those of you who have kids and you pay for daycare or childcare of some type. You can claim up to $3,000 tax credit for one child, or $6,000 if you've got two or more. Look, I totally understand it is not as common as it used to be able to have a single income and one person take care of the kids all the time. So these days, childcare is a massive and very common expense. Make sure if you're paying for that, you take the credit and you get that written off of what you owe Uncle Sam. Some of the things you're gonna need to be able to claim these tax credits. One is proof of the expense. So you're gonna need receipts or statements, and that will be used to kind of itemize what the total amount is that you're eligible for. I recommend using a software or a tax professional to help you figure out which one of these actually work for you. Don't DIY it. That's not the best way to go. Now, also make sure to double check your eligibility. Most of these things have a grid and income limitation. So I told you what the max amount is you can qualify for. You've got to go and look and figure out, okay, how much do you qualify for based on your income and how much you spent in that category. Last thing, file early. Rushing to do this right before the deadline often makes people miss some of these because they don't know where the proof is that they spent it, even though they know that they did, and they just kiss it goodbye and say, you know what, I'll figure it out next year. If you start early and you get your stuff in order, odds are you'll hit every single one and you won't leave anything to Uncle Sam that they weren't supposed to have. So you may have heard me say before that I have a bone to pick with tax returns. Look, if you've already overpaid the IRS, then go get that return. We need to claim back as much money as possible. So use the deductions and use the credits to your advantage. we can talk about and figure out how next year you avoid a return altogether, avoiding overpaying all year long, but that's for a whole nother video. Anyway, make sure you get your stuff in order, file on time, and get back as much of your money in your pocket as you possibly can. Make sure to like, subscribe, and comment below. What are the things that you want to talk about? I've been 16 years in the financial services game. I'm a licensed financial advisor. I want to help you better understand the world and the game of money, investing, and all the ways to protect against the risks you can't afford, but I need to know what you want to talk about. So comment below or shoot me a DM. Let me know what new videos we should be making.